Welcome to TheoTrade. I am Don Kaufman. You are watching the TheoTrade Weekend Update here. It is January 27th, 2018. A few factors that we're going to discuss prior to me looking specifically at a number of charts and a few option trades. Let's get right to it here. First and foremost, wild week once again in markets, ultimately to the upside. One of the initial factors that I really want to discuss with some of this movement to the upside is number one, the shorts. If you're short this market, you're out. What that ultimately means, and again, I know there's a couple people that are probably still holding some degree of a short position. But what I'm actually referencing here has a lot to do with the S&P futures, the SPX. Ultimately, if you're trying to short futures markets, you're ultimately out. And if you're trying to short any of what I term the monsters of tech, that's, our Apple, our Google, our Facebook, our Amazon out there, again, most of those shorts are out of the marketplace. Now, why do I mention this right up front? Like, why does that really impact maybe your either investments or trades moving forward? And what that comes down to for me is shorts. And you really do want shorts in the marketplace. Even if you're long the marketplace, you're an investor for a period of time, you need those shorts in the marketplace. Why? Let's assume that the market does start to eventually correct. What do shorts do to ultimately cover? So, you go out and you sell a product, for instance, at $100, right? You're short that product. And as the product drops, let's say down to 90, you buy it in, okay? Now, if you're an investor and you're a trader and you're long, you really have to consider this. When I say the shorts are out, okay, and that just means out of the marketplace, again, you have a lot of marquee shorts that are in there, whether they're hedge funds, okay, they're private equity funds out there. They're all standing up and saying, that's it, I'm no longer short the marketplace. I believe the position that puts this in is a quite dangerous position. When the market starts to sell off, you want those shorts to be there to ultimately buy back the market to cover, okay, to rebound from what could be some incredible selling. So you get a situation where there really aren't any shorts, and you can get markets ultimately in a free fall in a hurry. So that's really factor number one. Factor number two that I want to discuss in the markets is what I term efficiency, okay, and inefficiency. And right now, inefficiency looms large. So what does that mean to me? So I'm a bit of a quantitative trader, and I tend to look at expected moves in the SPX. Now, those expected moves are, of course, based on option pricing. So on a week-to-week basis, let's say, for example, an expected move is $22. All right, that means the SPX is expected to move up 22 or down 22. Now, this previous week of trade, the expected move was right around $32. Did the market move $32? Absolutely not. It exploded to the upside, literally doubling the expected move almost on the button. The only issue, it's done this now, okay, 3 out of the last 4 trading weeks, something we'll show you here in a moment inside of the SPX chart. So this is, again, a complete change of character for the markets, and I don't think enough people are paying attention. Again, it's a very quantitative measure. When I say a change of character, it's a transition from a market that's been incredibly efficient, meaning the expected move, if it said it was going to move 22 bucks, it hit 22 bucks and backed off. All of a sudden, we're seeing 40, 50, 65-point moves in the SPX inside of a week that was only expecting, for example, a $32 expected move. Now, last but definitely not least, there's really disconcerting moves inside of the dollar and inside, of course, bonds. Bonds have continued to sell off. Now, we're not in an incredibly threatening interest rate environment just yet, but as the bonds sell off, again, rates are starting to go up. At some point in time, the rates going up is going to influence a carry trade on the street. And what that means, and again, I'll put this in really simple terms, you get tons of trading firms out there that are borrowing, okay, immeasurable amounts of capital, billions of dollars of capital in a carry trade. And the idea is a very simple one. If they can borrow money, let's say at 2.5%, okay, interest, as long as they can make more than that, okay, good to go. And a ton of quantitative firms do this, and they use this almost like a carry trade, where let's say they borrow money at 2.5% or 2.6%, as long as they can actually amplify returns above that cost of carry, they're going to make some money out there. Unfortunately, in a rising interest rate environment, okay, there's going to be a lot of firms that are eventually going to throw up their hands and say, that's it, I'm out of the contest, and they will actually contract the amount of capital that they're willing to put at risk in the marketplace. We don't know precisely what that kind of cost of carry rate happens to be because it differs from different firms. Lots of people are putting it in terms of the TNX, which I will show here. And the TNX, they're putting it right around about 2.8 up to about 3%, and that's on the 10-year. Okay, that's the actual interest rate associated with it. You know, in addition to that, the dollar selling off, you've almost got this kind of perfect storm, if you will, all right, that really you're getting a weak dollar, which everybody loves because, you know, exports out there, all right, we can export, it's cheap, the dollar's down over here. But think about the implications of the dollar falling and interest rates rising and the effects that will have back upon the equity markets. With that, let's get right to it here again in this TheoTrade weekend video. All right, so let's continue over to the charts over here. Again, we're going to look at a couple of these key factors that we just mentioned moments ago. As I said, number one, the shorts are out of the marketplace. You know, very often people look at, for example, websites, they show like what the short open interest is. First and foremost, the short open interest, as reported by the major brokerage firms, is what they call their blotter, and they're only actually required to report in, all right, about twice a month on that trade blotter. By the time you get that information of who's short and who's not, you're, for the most part, getting some fairly stale information. So inevitably, when I talk about the shorts are out of the business over here, I am basing that predominantly on much of the large institutional shorts out there that are clearly coming out and saying that nobody could possibly hold shorts in this business at this point in time. And again, when you don't have shorts in a marketplace and we're exploding to the upside over there, it creates an extraordinarily precarious position. If the markets were to actually sell off, who's going to be in here ultimately to be a bidder? All right. Again, it can create a very illiquid position, especially, and we'll move away from the S&Ps because you know what? The S&Ps, hey, I get it. Some people will come in there. There's great liquidity providers. But when you start looking at individual like ETFs and so forth, that's where things get scary when there aren't too many shorts. The next thing that we discussed, of course, was what I termed inefficiency looms large. And when I say inefficiency looms large, specifically, I was talking about 3 out of the most recent 4 weeks. Well, let's count them out over here, if you will. First and foremost, we had a wild week to start off the year, followed by another back-to-back wild week. And again, the first 4 days of the year, we exploded and almost doubled the expected move. Thereafter, we did crack above the expected move. Ultimately, last week, we came right inside the expected move nevertheless. Okay, if you take a look at this week, almost double the expected move. And again, we were expecting this past week about a $32 move. Okay, I'll remind you, we hit double that. So it's a 2 deviation move. Now, you can back up in time, right? And you can look at other factors like when we've actually crossed through the expected move. And I'll tell you what, I'll even turn off my expected moves over here. And I've actually got auto expected moves. So I went back and I took a little gander at like the last 3 years of data, literally the last 3 years of data. And people, get this, at no point, not even to the downside, okay, did you see inefficiency looming as large as it currently does. That means at no point in the last 3 years in the SPX, from a week-to-week basis, did we exceed the expected move as drastically to the upside or the downside in any tight period of time like this. Meaning that, again, 3 out of the last 4 weeks, we've ripped apart the expected moves. It changes the entire notion, if you will, of an efficient market. And that's one of the things that, again, that's where we're a marketplace literally in transition at this point. And when you start looking forward. Now let's talk a little bit about forward. This coming week has about a $32 expected move, which is spot on pretty much what it was last week. And if you're always curious and everybody likes to go back and take a look at this stuff, if you are on thinkorswim, you can go to the Analyze tab, you can go to Think Back, you bring up the SPX, okay? And as we bring up the SPX, just come over here to the calendar, all right? Here we are on the 27th, just drop back just a hair over here back to the 20th. Okay, and you can take a look at the expected move of the previous week. With 6 trading days, we were just shy of a $32 expected move. Again, what that ultimately amounts to, the options market is pricing us to move up or down about 32 bucks. But the reality is, 3 in the last 4 weeks, we've smoked through that. Literally, you could be buying a straddle or strangle and would have made money. Now, at some point, what's going to happen at some point if we keep exploding like this through expected moves? Granted, you don't know if it's coming to the upside or the downside, but if you keep exploding through expected moves like this, what will occur is a wild expansion in volatility. Why does volatility have to go up? To account for the larger expected moves. And people, that's the transition we're going to be looking for to want to be able to sell options premium. All right. Switching gears a little bit over here, and then we're going to look at a few individual stocks, but switching gears over here for just a moment. As we said, the shorts are out, inefficiency looms large. Now let's talk about the rates and the dollar. Okay, I want to start with looking specifically at the dollar. And if you look at the dollar, it's only right to bring it up over like 5 years. Okay, and I talked about this extensively throughout the week here on TheoTrade and extensively throughout some of the evening videos, but we're out there. I mean, listen, we cracked through 92, which if you're a market technician, huge area, if you will, of support. We cracked through that. 90 at that point is just a big psychological level, and we're just going for it. Now, a lot of people look at this, weak dollar. Again, it's really good, all right, for the American economy. It's going to drive a lot of exports out there. I get it, okay? However, I also disagree to a point with it. You start to get a weaker dollar, and then you're going to be thinking to yourself, because this is a wild move. And again, this happens to be a 5-year weekly, but take a look at this, even on a daily. This move is getting drastic. Is it going to continue? I'm going to tell you right now, nobody has a clue. All right, you throw all the Fibonacci's and Bollinger Bands and MACDs on there. I got your 618 right here. It's not going to tell you anything, right? If this does continue, it's going to start to really pressure the equity and bond markets. And, well, why? If you're China, okay, if you're Japan, if you're in Germany, do you want to hold U.S. treasuries, okay, which are priced in U.S. dollars? Do you want to hold U.S. treasuries when the dollar is getting absolutely annihilated? Oh, no. So right now, as I said a little earlier, it's the perfect storm. This might make a lot more sense when you start to see it. When I say it's the perfect storm, if this dollar continues down, you may see the bond market get annihilated. And if the bond market starts getting annihilated, let's go over to bonds. Bonds, okay? The bonds, all right, if they really do start to feel that pressure to the downside, of course, what it's going to do, it's going to heat up those interest rates. Now, we're looking at the TNX, and I was referencing the TNX in that short little video clip over here. The TNX is now hovering right around, okay, it's about, and it says 26.76, but if you've never seen this before, that's how it's quoted in here. But what that amounts to, what it amounts to here in terms of rates is about 2.67%. Somewhere just north of here, you're going to hit a big inflection point. Again, lots of traders, big psychological level is at 2.8%. In fact, let's look at this over the last 5 years, just to give you a little bit of a feel how high rates are getting up to 3%. All right, the last time we've done it, you got to go back into what, 2013, 2014 kind of time frame. But again, what's the implications of the higher interest rate? Number one, it's a cost to carry trade. And a lot of firms may have to unwind positions. But when the interest rates start to rise, that's also going to impact Main Street, right? And that's when you have to start thinking about things like XHB. It's the home builders out there. And when I start to look at the home builders, okay, this might be it, people. They may have reversed. They're starting to get nervous. Now, Okay, I do carry right now a short position inside of XHB. I like full disclosure. Why am I short XHB? Because I keep seeing the interest rates go up, the dollar fall. Again, it's that kind of perfect storm scenario out there. And at some point, you're going to break the back, all right, of the home builders out there, because that's one of the first things that would fall. Again, rising interest rate environment. You're like, oh, it's spectacular. It's spectacular if GDP, which came out on Friday, was really, really good. At this point, you got to think to yourself, did the Fed miss their window? Did they miss their window? Did they miss their opportunity to really raise rates? Now, I'll come back to that maybe a little bit later. So that's the perfect storm. On top of it, we have a complex week coming up. And the reason I think it's a very, very complex week, if you start to look at things like the SPX, all right, and you look at the volatility, it's about 10% for the week. And check this out. I found this quite amusing. I don't often look at the diamonds, but I pulled up the diamonds because I'm looking for a trade idea. If you look at the diamonds, their volatility is closer to what? 12%. Okay. The Dow is expecting as much as almost a 350-point move this week. And I'll tell you why. All right. One individual stock. Now, again, this one is fairly shocking as I bring it up, and most of you will know I'm carrying a position in here as well, but Boeing. Boeing is going to have earnings this week, and when Boeing has earnings, check this out. It is a almost $20 expected move. Well, almost $21, but a $20 expected move. You're like, okay, so what? Boeing, right? For each dollar Boeing moves up or down, it influences the Dow. I'll just round it to about $7. So if you take $7 multiplied roughly by 20, do some quick math over here. People, just on the Boeing move, you have 140 Dow points that's expected. Could you imagine if Boeing hits it out of the park or Boeing actually falls flat on their earnings announcement over here? Again, it's a $20 expected move. 140 Dow points is what's expected just on Boeing over there. Again, I carry, albeit a very, very mild short position. My short position, okay, happens to be using in the money puts that are 48 days out. It's actually a synthetic short position that I took in there. All right. Additionally over here, it wouldn't be a weekend update if we didn't hit a few individualized underlyings here. And I want to do this justice. I want you to look at a 10-year monthly. Okay? I want you to look at a 10-year monthly on a number of underlyings, something like Intel. And please, by all means, do this for yourself over here. When you start to look at underlyings like Intel, look at the magnitude of the move to the upside. Again, the magnitude of the move to the upside. In fact, in this circumstance, to really do this justice, I'm even going to back out to the last 15 years. And the reason I want to do that is I want you to understand that the move that we're currently seeing, okay, is so historic that the move to the upside right now in a number of key and marquee underlyings is faster and harder, okay, to the upside than it was to the downside back in 08. That's how extreme people were getting. And that's the point that I think is being missed by so many traders and so many investors. We're not here to try to catch a top. We're never here to try to catch a bottom. But we are here to point out when there are extremes. And right now, wow, are we in the extreme? Again, I'm looking over here also at things like XLE, but again, some individual underlyings just to again, garner how wild this move happens to be. The move to the downside on something like Google was mild back in 08. Comparison to the upside move that we've seen, this is the monthly. In nowhere, okay, in this chart will you see any upside momentum as large as it currently is. Again, in a couple of key products. One of the ones I really had to bring up had to be Walmart. Again, you're seeing this spread through sectors. They just can't get enough equity exposure right now. And I think where you have to stand back, and a lot of people, of course, are going to email me and ask me, so is this it? Or are we going to fall from here? That's a question you're going to be asking yourself a tremendous amount. I think if you're an investor, either you hedge now or forever hold your peace. And what that means in some way, shape, or form, if you're holding long positions, I still want you to be able to make money to the upside. Nevertheless, if you don't hedge, okay, we know that the shorts are pretty much out of the market. The market can fall flat on its face. Okay, we know that there's inefficiency in the market. Inefficiency to the upside can flip around in a second and be to the downside. We know that they have an interest rate factor, and the interest rates are getting scary. The dollar is falling hard over here. You go out there, okay, and you take losses to the downside over here. That's got to be on you. You have the ability to mitigate risk using options. Do it. Looking at underlyings like Walmart, and again, we're comparing the upward momentum right now, okay, to the downside that we had in 08. Walmart barely had any downside in 08. Nevertheless, okay, even when you start to look, and this one's pretty shocking, even when you start to look at things like financials. Now, granted, financials, it was a long way down, okay, but even some of the most wild months inside of 2008, take a look in comparison to what you are seeing ultimately right now to the upside, right? And this is staggering over here. With that, I hope everybody has a wonderful weekend. We're going to get into some very specific trades this week, all throughout the week here on TheoTrade, on many of the items that I discussed here. Stay tuned. Thanks, everybody. Have a wonderful weekend. Bye-bye.